how do you guys actually make money, guarantee principal, get the accounts to grow? How does that all happen? And what we were talking about was using hybrid accounts that they guarantee the principal. There's insurance on your retirement. Here's what I like about that concept. You insure everything else.
Right.
You insure the car, you insure your house, you insure your health. Why on earth would you not insure your retirement?
Well, I think people are willing to listen to that now, Ben. I mean, they realize that insurance on their savings is a big deal. I think in days past, all people cared about was growth. But now people are saying, to heck with 20% rate of return. I just want to make sure I have my money at the end of the year.
Absolutely. I think so too, Hal. And to not have insurance in this day and age on your money, I mean, why do people put money in the bank?
For safety.
And insurance. There's
right.
insurance on their CDs if
right.
they're titled the correct way.
Right.
So here's an idea that we have. We use a lot of hybrid accounts that use guarantees and they insure your money.
Yep.
So if we can take a current portfolio that's worth about $1 million, okay, so it's sitting in the marketplace right now, and half of it's sitting towards equities. So we know half of it's at risk, and we know that the other half is sitting in a fixed income account. Let's say it's sitting in a CD, money market, savings account, whatever the case may be.
Right.
So we know that one is swinging wildly up and down,
right,
and the other side is doing minimal rates of return. So we're not too happy with the rate of return that we're getting. And I've seen CDs out there now. I've seen 2%, somewhere in that range. We're seeing the interest rates drop again.
Yep.
So they're not too fantastic right now. So we know that if the marketplace in that scenario drops, we'll lose money on half of the account, but the other half's going to get a minimum interest rate. If the marketplace surges, however, we will not get all the surge on our fixed account because it's getting a minimal interest rate, but the other half's going to go through the roof.
Yep.
So why don't we do this? This makes a lot of sense for people, and we do this quite a bit. Why don't we convert 90% over to a hybrid account? So we'll take 90% of the $1 million and put it into one of our hybrid accounts. And what we would do in this scenario is we'd use a 10% bonus on your money. So we would make your account worth $990,000 right off the bat.
Wow.
Okay. So we take the other 10% and we allocate it to a growth account. Alan, this is where your expertise comes in, but the growth bucket gets $100,000 immediately. And you know what I love this strategy for is because we have the husband and wife that'll come in, and one or the other wants safety. Right. One or the other usually wants the high growth, the high risk.
Right.
They want those big returns. And what this does is it satisfies both of them.
Right.
So one of them gets the high rates of return in the marketplace, and then the other one gets the safety and the insurance.
Right.
So what we've done now is if the marketplace goes up, let's use the scenario now. Marketplace goes up. How much of your account goes up at that point?
If the market, well, actually, both sides of the account would work then.
100% goes up at that point.
Right.
If the market goes down,
you lose the safe money has been protected.
We know that 90% of your account remains protected and insured, and we're playing actually with not your money, but we're playing with the 10% bonus that we got from our hybrid accounts.
Right from the get-go, you're on house money.
Absolutely. So how would you like to play with somebody else's money in this scenario? This is where specialists come into play. You can go to anybody that may have a hybrid account. It's just like this. I used this scenario. I was talking to a client this weekend, and I said, if I was a guy that sold a hammer, I could tell you how much it cost, where it was made, how it got here, and I could give you the hammer. But if I was a guy that could sell you a hammer, but I knew how to build a house with it, how much more valuable would that be?
Oh, absolutely. That's a good example.
So here's where the specialist planning comes into play. And let me give the 800 number again, 800-256-9006. Call in. We're limited on how many clients we're going to take this year. It usually makes sense for us to take accounts of $200,000 to $250,000 or greater so that these scenarios work properly. So I wanted to move on and talk about income. This is a major thing right now, Hal. Everybody wants income.
Right.
So we know that traditionally you could work for a company for 30 or 40 years and you had a pension for the rest of your life and you were taken care of.
Yep. Those days are over, Ben.
They're done. So what people are having to do is rely on Social Security, and they're having to rely on their retirement accounts as they take them from their work, do rollovers into IRAs or whatever the case may be.
Right.
But here's the problem, is when the portfolio values fall, the need for income doesn't fall along with the portfolio values. That's a huge problem.
Right. And that's where everybody is right now, Ben.
So the income actually, because of inflation, may be greater than it was before, even though your portfolio is falling. So I have an example, and we're using George and Barbara here. They had $1 million in the beginning of 2008. So they take $48,000 of annual income. It's about 4.8% of their portfolio. Did you say that's reasonable, Hal?
Oh, absolutely. That's the number I try to use, 4 or 5.
4 or 5%. So they have $700,000 at the end of 2008 after the market downturn happens.
Right.
But the income needs are the same.
Right. That's not changing, Ben. They still have the same needs.
So their distribution rate now becomes 7%. So if you have a client, Hal, that comes in and says, I need income, I need 7% of my account each and every year for income, what would you say to him?
You're going to run out of money soon.
Absolutely. And I'm going to give the 800 number out again, 800-256-9006. Again, when I tell you that we're limited, we are limited in the amount of people that we're taking. As you can see with the way the government's going and the economy's going, this strategy makes sense to a lot of people. If you have accounts that are worth $200,000 to $250,000 or greater, this is where these strategies make the most sense for people. Ladies and gentlemen, we're going to go to break. We will be back here shortly. Stay tuned for the Milks and Milks Hammond Mega Financial Hour.
I kissed her and she kissed me.
Welcome back to the Milks and Milks Hammond Financial Mega Hour. For information on anything you hear on today's show, call 800-256-9006. Call anytime, 24 hours a day, 7 days a week. 800-256-9006. Now back to the show.
Welcome back to the Milks and Milks Hammond Financial Mega Hour. As we left, we were talking about income needs, and we were also talking about how the need for income doesn't fall just because your portfolio falls. So what we're doing is we're talking about solutions in order to maintain income, maintain principal. We are talking about our hybrid accounts that actually ensure your retirement. So 800-256-9006, write that down. When I tell you that, whether you call or whether you don't call, it will have one of the most major impacts on your portfolio and the success of your retirement. I am not kidding with you. It actually will, because you'll look back a year from now and say, Benjamin and Hal were talking about that. It really didn't set with me at the time, but I should have called. Believe me, we are ahead of the curve in what we're doing. That's why we're specialists. So here's some potential solutions to income problems. Traditional pension type annuities. Hal, I'm seeing a ton of money flow out of the marketplace into traditional pension type annuities.
Yeah. Used to not be very sexy. People thought they were conservative and they didn't earn a higher enough rate of return and just kind of boring. Well, boring's in style. Safety's in style again.
Because actually, boring and safety actually provide a lifestyle that you're accustomed to, which can be sexy.
You bet. Again, I had a merchant tell me in Sarasota the other day, who would have thought staying even was the new success?
Absolutely. There's also government guaranteed accounts. There's income riders on deferred annuities. This is a relatively new thing. And I know that we're using that strategy when it makes sense, but I like the income riders on deferred annuities.
They're a big deal, and nobody knows about them, or not enough investors actually know that they operate. Let's talk about the income. Let's spend a little time talking about this, because this is a very big deal in my opinion.
Okay.
Income needs, I mean, that's the primary thing that when people come to see me, when they listen to our radio show, Ben, and they call me up and say, hey, Hal, I want to talk to you. When they come in, I'll bet you 8 out of 10 times today in the last 2 weeks, the people that have called up the radio and said, I need help, they're coming in to talk to you about income. So let's bang this point home.
Well, this is a really interesting concept that indexed annuities or the hybrid accounts that we've used have actually employed over the last couple of years. So we know that since so much money has flowed out of the market into these programs, they've had to compete to actually get your dollar. The win for the investor is that they got better. These programs got a lot better. So if you have a hybrid account or a fixed indexed annuity that's a couple of years old, 4 or 5, you need to look at seeing if there's an advantage to getting in a program like this. Here's how this works. Very simple. Usually, a lot of the time, the hybrid accounts that we're using, they will give you some type of a bonus up front in order to help you recover funds or get somewhere where you need to be. Then what they do is they attach an income rider to it. And essentially it works like this. Hey, if you're willing to keep your money with us, we will give you a guaranteed rate of return. And what this will do is if you ever want to draw income out of our program, we will base it on the greater